Okay, welcome everybody. Hello, this is Paul Hitchcock, and we're just getting ready to start here. It's just about 1 o'clock and setting up the technology because we're streaming this on YouTube, Facebook, and also LinkedIn. James, are you there?
Hi, all right.
Okay, there you are. So, hello everybody. Thanks for joining this episode of Wealth Protector TV. I'm Paul Hitchcock, and I'm here with my colleague James Nguyen. Welcome, James.
Hi, thanks.
Yeah, and we're going to jump right into this. This is our way of giving back to you. There's a lot going on in the world of estate and asset protection planning, and this channel here, Wealth Protector TV, is our way of keeping you on top of what's going on. I do want to mention to everybody, I'm going to put it in the chat right now. Let me do that. So we're going to take Q&A here, and I've got some emails from people that sent in some questions I'm going to get to. Feel free to type your questions in the chat box there. We will try to get to them. This is going to be a quick and dirty episode. And also, there we go. Type your chat into the your questions into the chat, and then also if you text "help me" to 650-459-2712, that gets you one-on-one as a follow-up with James for any particular questions on your own situation. 100% complimentary. Okay, James, let's get into this. So what's happening right now? I know it's changing day by day, but what is going on in Washington with the new
Oh,
laws that are coming down the pike?
right. Everything is changing day by day. Just to give everyone a quick background, the big items that we were worried about from the beginning of the year, we got proposals from the Senate, then the House, and uh, the the proposals started off very strong. They wanted to reduce the state and gift tax exemption from $11.5 million down to $3.5 million at that time. And a few months ago, they revised the numbers and said, okay, we'll just reduce it down to the $6 million exemption. And just recently, they took that off the table or off the chopping block potentially for now. We don't know what they're doing with the government. There's a lot of negotiations back and forth. So they might not even pass anything this year, but from the sounds of it, it seems like they're going to leave the gift and estate tax exemption alone.
Leave
And
the gift and estate tax exemption alone where it's at now,
correct,
which
correct,
would be
which is
the
great.
20, which was
Uh,
huge, right?
yeah, $11.5 million per person, so about $23 million per family.
Okay.
And just to explain what that was again is if a family wants to gift $23.5 million either during their life or after they pass to anybody, including their kids, the government wants 40% of that. So uh, the higher the exemption, the better it is for everybody.
Okay. When you're talking about those numbers, James, that number you're talking about businesses, property, where this comes into play, right?
Everything that they have, businesses, properties, life insurance if they don't have it in a life insurance trust, um, just everything that's in the person's net worth.
Okay. Now, let's say those exemptions stay in place.
Mhm.
Uh, are they set to expire anyways at a certain time?
Yeah, so these $11.5 million or $23 million for couples is set to expire on in 2025, or actually the
2025.
eve
Okay.
of 2025.
Okay. And
Yeah,
that's based on the last plan that was put forth. So whatever happens, it's going to expire at that point anyways.
right. And when it expires, it'll drop down to about $6 million per person.
Okay. All right.
Yeah.
So a big change there. So um, a question I have, and we've been getting asked a lot about this, is there's been talk for months now about any changes that come down the pike are going to start in January in 2022. So now we're here, November. How do you
Right.
deal with that scenario? I mean, let's say something passes, next week. that's a very short runway, right? So what's the thought process there?
Right. So again, we don't know what's going to be passed anymore. We had an idea of what it was going to be passed in the beginning, but those ideas kind of flew out the window. Recently, we were scared that they were going to take away what's called the grantor trust, um, or at least if you had a grantor trust, then it wouldn't be part of your. Well, it used to be that you could have a grantor trust, and you can still get the assets out of your estate, um, and that's what it is right now. However, they want to get rid of that provision, and they were threatening to get rid of that provision upon enactment. But that very recently just got off the chopping block as well.
What is a grantor trust? I mean, just briefly, how does that work?
It's basically how the trust is taxed. So it's a tool that we use to help um, transfer assets from parents to child and still have the parents be liable for the taxation, which sounds odd because why would the parents want to pay the taxes for the kids?
Right.
But the more taxes the parents pay on behalf of the kids, the more they can get out of their estate, which means that's less to the government taking that 40% tax. So
Okay. So it's a tool. So they've got to deal with the tax burden of the parents, because if the tax burden was on the kids, the whole grantor trust, it wouldn't work. Right. Yeah.
well,
And
if tax burden was on the kids, it wouldn't be a grantor trust.
wouldn't be a grantor trust. And what sort of assets are people transferring to kids through the grantor trust? And are there discounts available for that?
Right. So there are people have been transferring all different types of assets. The easiest types of assets are cash and bank and brokerage accounts because those don't require appraisals. They're they're easy to transfer, but there's no discounts that you get for transferring those types of assets. If you transfer things like LLC interest, um, portions of properties, business interest, then we might be able to get some discounts, but we have a higher cost to do so because we need appraisals to verify those discounts, verify the value of businesses, which aren't easy to value.
Oh, right. And which is where the time element can come into play too on getting that sort of planning done, right? Because if you're getting valuations on things, it's going to take some time.
Correct. So what's great from as we know so far, or as we're assuming, is if the government's not going to change those exemption amounts and they're going to maintain the grantor trust, which they might put back in the next day, we don't know. It gives our clients the opportunity, at least until 2025, to start considering or working out a strategy to transfer wealth from themselves to the kids.
Okay, because we know that the exemptions are coming down substantially.
Correct.
So there's a longer runway to get things done.
Right.
Yeah.
Right.
What else is on the chopping block right now, James? I mean, there's this whole big hubbub about the exemptions coming down. And if that's not happening, or we don't know, and it still could be in play, but what else is going on that families need to be aware of? Like what's on the table? It's a massive package. So there's got to be more.
And there was a lot of things that was on the chopping block that they've slowly taken off the chopping block. So the things that they had were like they're going to take away discounting from families. So if they had taken away the discounting that you're allowed to get from transferring minority interest to kids or the businesses to kids, a small percentage of businesses to kids, then that would have been a big deal. But they recently took that off the chopping blocks. As for what's back on, honestly, I can't really tell anymore.
Because it's in flux right now.
Right, it's still in flux. Recently you heard of the wealth taxes. They're going to tax the billionaires, but that recently was taken aback too. So they're daily putting things on and taking things off. It's hard to follow. It's really difficult to plan during this period of time. But um, yeah, you need someone like us to keep a pulse on what's going on in Washington.
Right, because change that the winds of change are howling right now. So we know there's going to be change because they're trying to find ways to pay for that spending package, right? It's
Right.
just it's just that um God, it's gone back and forth so much. Um, what are the strategies you've been focused on? You know, regardless of when these changes take place, we know there's going to be a reduction in the transfer taxes in just a few years. Gifting, right? So gifting has been something that the firm has been focused on. What's going on with gifting strategies?
Yeah, gifting strategies. Um, like I said, we were focused on making the gifts from parents to children recently because we anticipated that they were going to drop the exemption amounts. Again, now there's more breathing room to make those gifts, and we don't have to rush to uh, likely to complete it before the end of the year, which buys us a little bit more time. Um, but we still need to continue to plan for those gifts to be made before
Walk
2024.
me through that process of gifting. So can you give me an example of how gifting works and the
Sure.
strategy, like what's used for the gift? Like, just walk me through that a little bit.
Right. So when you make gifts to kids, there's usually a handful of ways to make the gift to a kid. For example, one option might be just to give the child the money directly or the properties or the businesses directly. Many people do that option. However, when you do lose out on some opportunities for the children. So, for example, although the gifts that you make to kids are considered their separate property, especially in the community property states, um, those are more likely to be commingled with their community properties or their joint accounts, and they might start to lose that separate property nature.
So you mean like
So
if you give cash to a kid
mhm,
or stocks, bonds, and cash, they're going to start putting it in their family assets
right, it
and
starts to get commingled together.
commingled. Okay,
Right.
which is a bad thing.
Yeah, usually that's not what they want to do, or they should do, especially if it's a gift from their parents. Um, so another option that you have is you can gift it to the kids through trust. Now, there's a lot of different types of trust that we can use to gift the assets to the kids, but just as um, simple revocable trust for the benefit of the kids. And we can structure this trust in many different ways, add in a lot of different asset protection tools inside the trust. So the child can be sure that the assets that they were gifted from their parents to them are protected from, spouse, from unseen creditors. If
An
the
ex-spouse
child,
or current spouse.
current spouse, ex-spouse, creditors, or let's say they fall into bankruptcy because of bad business dealings or personal guarantees, those assets that they were gifted from the parents would be off the table from those liabilities, which is really
Okay.
cool.
So this gets into one of the questions I wrote down here is that this person asked uh, about this very arena about, so this is, they're asking, is this a trust that the parents set up during their lifetime? So they're asking kind of
Right.
how does it happen? It's not a trust done after the parents are gone. How do you set it up? When?
Sure. So when you make a gift during your lifetime, you should also set up a trust during your lifetime for the gifts to go into. Um, so it is a trust made during the person's life. We set up the terms of the trust. We can't, or we usually don't have the parents be the trustees of that trust, the managers of that trust. We can have the kids be the trustees. We can have other third parties be the trustees, friends and families. There's advantages and disadvantages of each and all of those options. Um, and these types of trusts are very flexible. There's a lot we can do with them. Um, so
Is this
it's
an
a hard
irrevocable trust or a revocable trust?
irrevocable trust.
Irrevocable. So the
Yeah.
parents in their revocable living trust will set up a provision in there for an irrevocable trust that will receive the assets they're given to the kid. Is that right?
Not no.
No.
So if it's being gifted to the kids during the parent's lifetime, then we would create a separate trust, separate
Okay.
irrevocable
Okay.
trust for the parents to give those assets to the kids.
I
Now,
got it. Okay.
if the parents want to leave the assets to kids when they pass away, then we have a, through their revocable living trust. Inside that trust, we'll have sub trusts inside there that are irrevocable,
Got
and
it.
we can structure those in uh, many different ways.
Okay. Okay.
Yeah,
And I've heard you talk before, James, that the one of the benefits of doing that is your kids are receiving assets, just not getting them outright, but they're
right,
going into a protected trust, which protects it from the potential liability, and the parents can lay out the terms of how things are spent and so forth. Is that
correct,
right? Yeah.
correct.
Yeah.
Yeah, I think all living trust or any um, clients out there that has a living trust or might not have a trust yet, they should at least consider the option of leaving the assets to the children in these protective types of trust,
Okay.
instead of giving outright distributions. It
Okay.
really depends on the client scenario, though.
On a side note too, because this question is somebody was asking about the changes going on, the estate planning changes. They said they've got a special needs child.
Mhm.
And so they're asking, are there things you can do for a special needs child?
Right. So in your revocable living trust, um, when you leave assets to children and they have special needs, meaning that um, they might qualify for some government assistance or government programs, and those government programs are typically means tested. So it's based on how much the child's assets are. So if we left those assets to those children outright, or even in a trust that's not properly designed, then that child would be blown out of those government programs, which is not good. So uh, in the revocable living trust, we would have to make sure we had special needs provisions in there. But even if the parents want to make gifts to the special needs kids during their lifetime, then those irrevocable trusts that we talked about before should have special needs provisions as well. So
Got it.
you can still
Okay.
gift to those kids, just has to be done in a certain way to avoid that landmine.
Okay. And another question here is about the AB trust.
Hmm.
And so this person says they have an AB trust. Is that still an
Necessary?
effective? Yeah, necessary. And I know
Right.
we had some content going out about that. So could you explain the AB trust and what's changed there?
Sure. Yeah, so a lot of the older trusts, they force an AB provision in there, which means for those of you that don't know, there's many types of trust, but a common one is called an A only and an AB or an ABC trust. And in an AB trust, essentially what that means is when one spouse passes away, the trust has to break into two separate trusts, one for the surviving spouse, one for the decedent spouse. And you have to put the assets into each one of those trusts. And the surviving spouse's A trust is completely for the surviving spouse's benefit. They can do whatever they want with it. They can change the terms, modify everything in their A trust. It's for them. The other side, which is the B trust, is still for their benefit, but it becomes an irrevocable trust. There's a cap to how much can go inside of a B trust, which is that estate tax exemption limit of currently $11.5 million. So anything above that amount would either fall into back into the A trust or go into a new C trust, depending on how we write the trust. But essentially, since the B trust, it becomes irrevocable. It's we can't change the terms of that trust. We can't say it goes to a different set of beneficiaries. Can't go to new spouse, new or we could restrict it from going to charities. Usually the B trust is locked in saying it goes to the kids or whoever you guys, the parents have chosen already. So that provision was typically done to maximize the gift and estate tax exemption. And it's still a great tool, but a lot of people have been reconsidering whether they need to have that A-B split or whether they should change their trust to just be a only trust, meaning when one spouse passes away, everything goes to the other spouse and they just run with the money that they can do whatever they want with it with full freedom.
So anybody that's got an old AB trust, the idea is to get some input on it and just make sure it's still relevant for your situation.
Right. Just gotta make sure that it matches the needs of the clients today.
Okay. All right. Now, for this, the changing scenario out of Washington and with these new laws that are coming down, I mean, something is going to happen.
Right.
What would you say are the hot issues now? I mean, they're not going to have nothing happen, right? So if the transfer tax is off, and a question about that, James,
Right.
the transfer tax, just for clarification. So when you go from one generation to the next, parents die, everything you own is there's a number put on that, and that is what is taxed?
Correct. So everything that you own, they put a number that's your net worth. And if that number is above that exemption amount, they tax that overflow.
Okay. And if you own a home, you got debt on the home. How do they value a home with debt on it?
Yeah, so they just take the fair market value and then they subtract the debt. So the debt isn't included inside that calculation.
It's not.
Right.
Is it for probate purposes?
For probate, it's not well, that's a tricky question, but the question is the mortgage would be considered in a probate. The reason why I hesitate is because there's a question of how much the fees in probate is usually attached to the gross value, not the net value.
Yeah, the gross value. That's what I was getting at. The
right.
Gross value is the statutory fees are attached to that in probate.
Usually.
Okay.
Yeah.
And okay. So getting back, I want to clarify this question because this came up in a webinar we did last week, and I think our founder Harry mentioned it. But there was a client who transferred an asset into a vehicle where then that asset grew. I think it went from, I don't know, it was something like a $7 million asset that went to $90 million over a period of some years, but it grew in a vehicle and it was out of the client's estate.
Right.
What is that scenario? What's that structure?
Sure. So we go back to the focus, which is anything above that $23 million under today's value would be subject to estate taxes. So when clients hit that threshold, when their clients reach around $23 million of net worth, they want the next dollar to be out of their estate because any more money that they create is going to be likely going to be subject to estate taxes, that 40%. So what many clients do is they set up what's called could be a children gifting trust, but usually like a dynasty trust where it goes from generation to generation and then avoids that estate tax. And they would start up businesses inside these trusts, things that they believe is going to blow up in value. And the investments or businesses that they put inside these trusts, if they do blow up in value, all of those value is outside of their estate and avoids estate tax, which is fantastic. Not just for the children, but it'd also be for the children's children and the children's children's, etc. There's laws that, I think they've been trying to put that on the chopping block recently too.
Right.
But that's also one of those items that's are on and off the chopping block.
On and off. And okay, so you can put an asset in there. Do you lose control over that asset if you put, like, let's say you run in a business, you put it in there. It can't be about losing control, right? Because you're running the business. So how does that work?
There's ways to maintain control of the business.
Okay.
So for example, in those types of trusts, usually the settler, the person who creates the trust, can't be the trustee, but someone else can be the trustee, and then the settler can still be the manager of the underlying business, or the CEO, or the control person in the underlying business.
So if you had an arrangement with your child, for example, maybe even
Right.
your child's in business with you, or I don't know, but then that's where it all works out. If you're, have a family and you're investing and running businesses together and so forth.
Correct. So if you have a very strong family bond, there's a lot of ways to leverage that to essentially beat the system.
Right.
Yeah.
Right. Yeah. Yeah. And I want to mention too, for those who came on a little bit later, so if people jumped on, is things are changing by the minute here. As James mentioned, they're haggling in Washington. I think we all understand, what's going on there when it comes to the horse trading that's going back and forth. Nobody knows what's going to come down and be final. It's fascinating to see what's going on, but they're going to have to pay for their whatever it is now. 1.5 trillion. It was like 3.5 trillion. Trillion, not billion. It's unbelievable. But next Friday, we're doing this again. Our founder and Harry Barth is going to be breaking it down. So between now and then, could be just an avalanche of information. And so stay tuned. We're doing this again next week, and I encourage you, if you text help me to that number in the chat there, you can get one-on-one for any questions. We're probably busier than we've ever been as a firm, helping people look at their planning and to get in front of the changes that are coming down the pike. We're just sitting there on the precipice of these changes. And so we're poised, doing things now. Many clients are gifting. James, you've been, crazy busy with these strategies. Yeah. So we're just cautioning everybody, take a look at your planning. If you don't have any planning in place, estate planning, a living trust, get that done. We all have some level of an estate that needs attention. If you do have it in place, then, get with us. Happy to do a complimentary session, look at your planning, see what's going on, and get updated. And really want to thank you, James, for being on here and giving us some level of what's going on, some of the things that are on the chopping block, others that aren't. And thank you, everybody, for joining. And we will see you again soon. Thank you.
Thank you.
Thanks, James.